Welcome to Swing Trade Pro 2.0, the 5-step swing trading blueprint. I'm Frank Ochoa, president and founder of Pivot Boss and author of the book Secrets of a Pivot Boss. And in step 2 of Swing Trade Pro, we are going to discuss trade sequences. So step 2 is all about finding high probability opportunities, and the blueprints and the trade sequences that we will study are designed to help you find these high probability opportunities in any market and in any time frame. So we're going to discuss how to identify these blueprints and sequences, how to identify where the absorption zones are, the entry points, and even the failure points, so you can be confident in executing these opportunities when the time strikes. Step 2 of our 5-step blueprint introduces trade sequences, which help traders find and trade opportunities in the market. You'll learn how to identify and trade specific day types and multiple day trade sequences using blueprints that detail every absorption zone, every entry point, and every failure point. The day type blueprints are designed to help you identify and execute entries for single sessions that are statistically important in the market, while trade sequences string together several day types in a row that will collectively fuel the next move. These blueprints are designed to help you find high probability opportunities in any market and in any time frame, and come with specific guidelines for executing and building positions. Thoroughly understanding these blueprints will give you the power to confidently execute trades in any market when the opportunity strikes. And what's important about this section here is that we're going to get 5 different day type blueprints and 4 different trade sequences, and each of these can be played as day trade type of plays or as swing trades as well, in addition to these as well. So these are very, very powerful patterns that recur in the market, and being able to identify these patterns ahead of the crowd will allow you to position yourself ahead of the next major move. So let's go ahead and get started with these day type blueprints and the 4 sequences. First, we're going to start with the rejection day blueprint. Here is the rejection day blueprint. The rejection day blueprint is very, very powerful. Again, from my book Secrets of a Pivot Boss, I've discussed the rejection day before. This day type tends to precede powerful reversals. Absorption days typically follow this day type, which fuel the developing reversal as well. And so what we're looking at here is this session right there. That is a 1-bar session. It could be 1 daily bar, it could be 1 weekly bar, it can be 1 60-minute bar or 1 15-minute bar, whatever the case is. But for the most part, when we're talking about swing trading, we're usually discussing these as daily bars. But for right now, what we're looking at is the construction of the bar, the geometry, what makes this bar what it is. So number 1, let's look at the background of this bar. So over here you can see rejection days develop at price extremes, like a previous high and low. That's very important. If you have support and resistance here, then a rejection day, typically speaking, in a bullish rejection day, you would want it to happen about right there, right? At support. So a significant rejection day will tend to happen at the extremes of a price range. In this scenario right here, you can see 2-day lows are right here. Price breaks down through 2-day lows and drops significantly, and then turns around and closes the day much, much higher, back above this support level, and typically, in the strongest sense, back above the previous session's midpoint. So this golden dot right at the center of each of these ranges is the midpoint of that day. And typically speaking, when you have a major rejection day, this midpoint will be at or below where the stops came out in that session. So again, this is a very, very important part of this chart. Now, rejection days have a range that is significantly larger than the 10-day average or even the 50-day average or whatever. For the most part, this range from high to low is significantly greater than usual. So if the average range is this in most cases, then this range here will be greater than average by 25%, 50%, sometimes 100 or 200% greater than average. The larger it is, the more significant that day is, the more significant the rejection is. Typically speaking, what we're looking for is a daily range that is at least 125% of average, and that would be significant. Again, anything greater than average would be a big deal, but typically speaking, when you have a rejection day, you want it to be at least 125% of average, or 25% greater than average. The ideal swing entry for this type of rejection day is the midpoint of the pattern. So again, this is the midpoint right here. That is the most important part of this pattern. Typically speaking, you need price to stay above that level on a closing basis. Otherwise, that rejection day is now broken. So you need price to continue to remain above this level on a daily closing basis. That doesn't mean that price can't drop below that level the next day. It can. It just needs to remain above it for the most part, because that offers the best entry point. So the next day, when price is to pull back to the midpoint, that offers a great spot to enter the trade at the most favorable trade location, and then hopefully you get a continuation in your intended direction. If at any point price were to close below that midpoint for a day, that would negate that trade, and now you would likely see a push to the low and perhaps even lower. So again, the midpoint is very, very important. So a few things over here. Number one, these rejection days tend to develop at price extremes like previous highs and previous lows. The rejection days tend to be significantly larger than the 10-day average. The ideal swing entry is the midpoint of the rejection day, which can be defended 1 to 4 days after rejection. And a daily close below the rejection day midpoint breaks the pattern, as this would indicate a retest of the rejection day low. Those are some of the most important points. Now, when you get over here to the measurements, this helps to define things a little more. So when you're talking about the range of the pattern, it needs to be greater than 125% of ADR, ideally. Like, this is not a rigid thing, but the greater the size, the more significant the rejection. You can have something that's 100% of ADR, which is perfectly average, and still be a great rejection day. It just needs to be at the right spot in the chart, and certain things need to look the right way. But for the most part, the bigger the range, the more significant the rejection. The tail is this part. That's the tail. And ideally, that part of the range is usually about 2 to 2.5 times larger than the body. The body is the distance between the open price and the close price. This is the open, this is the close, that's the body. So this tail would be at least 2.5 times greater than the size of the body. Again, that's not a hard and fast rule, but typically speaking, the greater the size of the tail, the more significant the rejection. So I think if you were looking at, for example, 2 times the size of the body, that's probably the smallest definition that you can have for a rejection day. So the greater you go, say 2.5 times, or maybe 3 times, or 3.25 times the size of the body, will give you a more significant rejection. So that's very important. Another point of emphasis is the close price. The close price is usually in the upper 35% of the day's range, so in the top third of the day's range. If price had closed, say, just above the midpoint, it's not that good. It's not as strong. You want price to have rejected away from that point and closed much higher. So typically speaking, again, the close needs to be in the upper 35% of the day's range. And if the close closes above the previous session's midpoint, that's a bonus. That tells you that that market is even more stronger than at first otherwise suspected. So a major turnaround from these lows, and to close back above the previous mid, very, very bullish. Now if you look right here also, the next section is the mid. The midpoint is the high plus low divided by 2. The high plus the low divided by 2 gives you that point right there. The ideal swing entry is this point. So if this is a daily bar and you've rejected a major area here, then over the next 1 to 4 days, there could be defenses in that area for the next 1 to 4 days. Ideally, you want absorption to occur 4 days or less, and then you need price to start going in your direction. Because if not, each day that bulls come in to defend and defend and defend without getting paid opens up the downside stops to a potential trigger and a stop run. So if these bulls are defending here, typically speaking, they'll be putting stops down the way, all the way down below the low. And if this area fails to hold, that's where the stops would get triggered. And now, in most cases, I'd say 99 out of 100 times, 95 out of 100 times, if price closes below this midpoint on a daily basis, it will take out the low 99 out of 100 times in most cases. So that's why if I am in a swing trade and I'm defending off that area, if there is a daily close below that midpoint, I might as well just get out before the close that day, because the likelihood of taking out the low is very, very high. So in this case, the midpoint is the failure point to watch and also the entry point to watch for this trade, which makes it a very, very solid opportunity because your risk is very, very small in this area. The other thing is the location. This pattern is powerful when it's paired with market structure, previous lows, and low volume nodes. So anywhere where there's rejection seen, if this pattern develops at a major point of emphasis in a chart, say at support, at an LVN, or again, market structure support, those areas are very, very powerful. It can even be in the PIMA trigger zone in an uptrending market. Pullbacks to the moving averages, seeing this type of pattern, provides a very good buying opportunity as long as that midpoint remains intact. And lastly, entries. There can be multiple entries, but the ideal entry is the midpoint right here. But this entry wouldn't occur until the next day, because if price is up here and it's confirmed that move by the end of the day, then it's the next day where price may pull back to the midpoint, or perhaps day 2 where price may pull back to the midpoint. So that is the ideal entry point in terms of trade location, because you will have minimal adverse excursion away from that level. If that is the entry, it's likely going to continue higher unless there's a close below it. Now, if you want to get in before the next day, then my typical entry is somewhere in the last hour of the trading day. So in the last hour of the trading day, that could be an opportunity to enter this market, at least in some level of size, some level of exposure, whether it's half size, a quarter size, whatever the case may be, and then you can add to it if price were to pull back the next session. So there's multiple points of entry here. Number one, if you have a significant rejection day, by the end of the day, in the last hour of the day, there's an opportunity to enter that trade, or the next morning, there's an opportunity to enter the trade on a pullback to the midpoint. So those two are the big points to defend. Now you can see up here, entry number 2 says, secondary entry is a retest of the rejection day's high and close from above, which can be defended for 1 to 2 days after rejection. So say the next day doesn't pull back to the mid and instead gaps up. That gap up and a pullback into this zone would provide a defense opportunity, and that becomes an opportunity for bulls to defend, either adding to their position or initiating a position at that point. So those are the major areas to watch for a rejection day. So again, this is the most powerful type of rejection signature that you'll see. Again, if it's at a major edge like a composite low volume node, or at the previous month's low, or at a key range low, those types of rejections tend to bode very well for a reversal back up over the next either 1 to 5 days or as long as 2 to 3 weeks out. So it can be a very powerful signature of rejection depending on where it occurs. Let's take a look at that right here. This is when resorts, and you can see right here, case in point, a major rejection day. This rejection day developed right at the 160 level. This 160 level had been significant support for this stock. Price pushed through it here, came back, made it support, and then rallied. And then here on big news, price pulls back to that area and holds and holds and holds until it comes down and tries to push down below 160, getting as low as 156.54. Now remember, intraday, when this thing is dropping and it's down at these lows, it looks like a red bar down here. It looks like any one of these red bars at the very low of the day. When it was at 156.54, it looked like a complete red bar. But by the end of the day, price closed back at 162.98. 162.98. Look at the midpoint of that bar. The midpoint is right where the stops came out. It was a huge day and a huge rejection. Now, in this case, there's a couple of ways that you can engage it. You can get in at the end of the day here. So if a rejection day is confirmed by the end of the day, you have the option to execute an entry during the last hour of the day. It could be much earlier as well, but again, with rejection days, they need to be confirmed by the end of the day, because sometimes it may look like this by lunch, and you could make an entry because you think it's going to hold the rest of the day, but then by the end of the day it could have closed way back here, and now there's no rejection day. So you have to confirm this pattern by the end of the day, and that's why I say here, if the rejection day is confirmed by the end of the day, you have the option to execute an entry during the last hour of the day. The second entry opportunity comes the next morning at the absorption zone. So if the rejection day is confirmed by the end of the day, you have the option to execute an entry at the absorption zone the next day. The absorption zone is the zone at and around the midpoint of the rejection day and the level where the stops came out. Which was the level that was violated? 160, right? 160, the stops came out. That's the major level as well. So between the midpoint and the level that was broken, that is your absorption zone. So if price pulls back into that area, that offers an opportunity to defend for a continuation higher. And so again, this type of day type is very, very powerful, and it can be very simple to find at major areas in the chart. And from there, it's all about engaging the opportunity to get the best trade location and to add to that position if it continues to work out in your favor. And there's various areas to add back in the sequences that we'll be looking at ahead. So the rejection day type is a powerful pattern. And whenever you confirm it at a key area of support or resistance, again, it can be a major indication of a reversal to come. So again, this is a very, very powerful day. This rejection day right now, anytime you see a rejection day like this, you can forecast from the low of that rejection day. Remember, 156.54, and I use what I call the Pivot Boss ADR method targets. And from there, I'm able to forecast higher what the average move is likely to be based off of recent price action, and I get a good target that 170 to 173 could be the next target zone. So when I took this trade back in the early spring here, we were looking for price to pop up toward 170 and as high as 180 on this rejection. Let's talk about the absorption day. The absorption day is a day that would come after a rejection day. So you saw when resorts had a major rejection day, the next day has a high probability of being some sort of absorption day. Now the absorption day is typically a range-bound day that is designed to facilitate trade between market participants. This day type fuels the forthcoming move. So basically speaking, when you have a major rejection like this, the next day is designed to be a small range day that stays very, very close to this zone so that bulls can come up here and build a position, defend, and build a position throughout the course of the day or multiple days. Again, absorption can occur 1 to 4 days after rejection. This is day 1 absorption. And the idea, typically speaking, is if this is a rejection day and you want to get in the next day at the absorption level, which is here, then ideally you want price to open the day above the rejection day midpoint. If price opens the day above that midpoint, then any pullback to the absorption zone offers an opportunity to defend and build your position. So that is the primary idea. So let's talk about the background a little bit. Absorption days develop after significant rejection or expansion days. Absorption days typically have small price ranges, which offers two-way trade for market participants. Absorption days are days when bets are being placed, as market participants are eager to position themselves ahead of the next move. An absorption day can develop by itself or in a series of days before building enough energy to fuel the next move. Again, it can be 1 to 4 days out, safely 1 to 4 days. It can be longer than that, but when you're talking about swing trading and a major rejection day here, 1 to 4 days is about what you need, because on day 4, if it's not going by day 4, it's probably not going to go. Or it may take much longer and your money could be used otherwise, right, in a different opportunity that is moving. So in this case, 1 to 4 days is about the max that we'll look for absorption. And additionally, failed absorption usually leads to significant stop run days. So again, if you have day 1, day 2, day 3, day 4, and you still haven't gone higher, then any move through the absorption zone will likely trigger a significant failed absorption, and you can have a major stop run to the downside, which actually happens to be one of our trade sequences that we will discuss later on. Now, when we're talking about the actual measurements for this pattern, over here on this side, the range, again, is rather small. So if you're talking about daily range, average daily range over the last 10 days, 100% would be the average. You know, something around 75% or less would be about what an absorption day would look like. So say somewhere between 60 and 75% of average daily range, that would be what you get here. So it's typically a smaller day, and we can quantify that by being below 75% in most cases. Now, the close of the rejection day or the expansion day is usually above the open. So the close is usually above the open. Here's the open price here. It drops down into the absorption zone, and then it pushes back up to close a little higher. Now, that's not always the case, but it's usually the case. You need price to open above the mid in order for there to be an entry opportunity, and then in most cases you'd like for price to close above the open as well. Now, the low of this bar right here of the absorption day is near the rejection day midpoint. So any pullback, again, would likely be defended around the previous session's mid, which is the rejection day midpoint. Now, in terms of entries, again, the ideal entry is the midpoint of the rejection day, but again, price must open above the rejection day mid for an entry to be considered. Several rotations into the trigger zone can occur during an absorption day type. So that means that price can drop down early in the morning and bounce, then again in the morning and bounce, then again in the afternoon and bounce, and you could see several rotations into that midpoint throughout the course of the day. It doesn't just have to be one hit and go. Now, those are the best if it just hits and runs off, but most times you can expect several rotations into that zone before bouncing off. So again, this is a powerful, powerful day because this is where the bets are placed. When you find rejection, look to identify the high probability entry zone, the ideal trade location, and from there look to execute an entry when price hits that zone. This is what it looks like in that win trade. Now keep in mind, when I took this trade, I waited for the next day. This was the Steve Wynn allegations, and so price dropped heavily, so there was lots of headline risk in this stock. So when I entered this market, I didn't want to get in at the close of that day. I wanted to see how the overnight was going to look. I wanted to see how the price was going to open the next day. And what you see here is that price opened higher. You see, that's the open. And this is a still developing day. So this is in the morning, and price has not closed yet. So if you see the pullback after the open, it drops into the absorption zone, the primary absorption zone, which is the spot between the midpoint and the rejected level. Look at price, it drops right into that zone, and that is when I place the entry. So right when price drops into that ideal entry zone, that's where I get into the trade, and this is what it would look like at that moment in time. So again, this is what it's supposed to look like when you enter the trade. By the end of the day, who knows what that bar is going to look like? But at this moment in time, that's what it should look like when you enter the trade. It should be bearish, it should look red, it should be dropping right into that midpoint but holding. So that is very important to understand the developing day and how it looks when you trigger an entry. So basically, in the ideal scenario, an absorption day will develop after a significant rejection day, and this day will allow you to enter trades at a favorable trade location before the reversal begins to take shape. In this case, bulls defend the absorption zone at 160. I was one of those bulls here. Now, keep in mind again, when executing an entry during an absorption day at the rejection day midpoint, the day's bar will be incomplete and appear bearish, but ideally, price will turn around and close the day higher. Now, those are the two entry points, right? You have this rejection day, you can get in at the close of that day, or you can enter at the midpoint here. You can do both as well. You can get in some here and add to the position here, or in my case, I went in 100% right at that level. Now, again, what's very, very important is that price needs to close above that midpoint. If on this session price were to close lower and close below that mid, I'd be wanting to get out of that trade before it gets worse, because in most cases it will take out that low. So again, it's just a very, very important point that you have to understand, that if price closes below the midpoint of a rejection day, all you have left is hope, because it's not likely to turn around. You're going to be hoping that it turns around, and it's not in most cases. Again, 99 out of 10 times it's going to take that low out, so might as well get out early. That's why the midpoint is so very important. Now if we go forward and look at how the rest of this trade played out, this is the day of absorption. So it didn't turn into a full-on absorption day by the end of the day. It was more of an absorption morning. So price stayed here in the morning, held, bulls got in, but by the end of the day, price closed above the rejection day high and closed higher. That is exactly what you want to see. And again, price pulled back a little bit lower than that midpoint, which is fine. It can do that during the day, but it needs to close above that point by the end of the day, and it did in this case. So again, a solid entry point. For this one, not much adverse excursion away from it. Everything else was positive excursion, which is fantastic. So in this case, there are several keys to good rejection days. And rejection days here, it reads, are significant days in the market, but not all rejection days are created equal. Several keys to good rejection days are the significance of the rejection, so the size of that rejection, how big is that day, also the level being rejected. How significant is the level being rejected? 160 was a significant level in the market, a major LVN, a major area of support that it had not been below for a long time. So when it tried to breach that level and failed, that was significant. The day type was significant, the level was significant, and then from there, how quickly did the market pop off that absorption level? So how price responds to the absorption level is another very important point, and then how quickly do you get paid in that trade is the other important point. The price didn't just sit there and not do anything. Like over here, for example. Is that a rejection day? There's no signal. This is an automated signal. There's no signal here, which means price didn't close in the upper 35%. In this case, it's clearly a big enough day. The This tail right here is clearly long enough compared to the body, but price didn't close in the upper 35% of the day. And then look at the next day. It closes below that midpoint, and while it didn't take out the low right away, it went sideways for way too long. 1 day, 2 days, 3 days, 4 days, 5 days, 6 days, 7 days, failed new high, 8 days, 9 days. That's not what you want to see. You want the ability for that move to make quick profits after you get in. You want to see that thing hustle. You want it to see higher highs and higher lows day over day. You want to see a continuation. And so again, there's several keys that make a great rejection day. Number one, the significance of the rejection day combined with the significance of the key level that was rejected. That was huge. Number two, price rallies after bulls defended the rejection day midpoint on day 2, which offered an ideal trade location with minimal adverse excursion. That is significant. That's why I created the midpoint where as the entry, because it statistically works in my favor. I've seen it play out time and time again over the last 15 years of the market, maybe even longer. All of this was quantified with all of our automated strategies that I created from before. Every single time we'd have a rejection day here, I was always taught, hey, let's get in at the open of the next day. And every time I did that, I saw our automated positions go down first and be underwater first before going in the money. And so what I mentioned at the time was, you know what? I'm going to let price and the trade go against us before I enter the trade, and then get in at the midpoint and jump in down here. And that has been a very, very powerful way to engage entries whenever you see rejection. So again, that midpoint has been significant and remains that way to this day. So continue to watch it, continue to use it as a launch point, as an absorption point, and any failure to hold that level would ruin the trade. Again, anytime price takes off and pops in your favor, you want to be able to take profits along the way. And so you're either taking partial or full profits depending on your plan of attack. So again, anytime price pops in your favor, hits new highs, those highs right there are designed for you to pay yourself, whether you pay yourself on the full position or whether you scale out and pay yourself along the way. That was a huge move. Got close to 170 and then popped up and continued higher, hitting 180, the top end of the range. That was a great rejection day, a great absorption morning, and a great continuation out of that trade. This is one of my favorite rejection patterns right here, and it's what I call the failed new low. The failed new low day type is very, very powerful. It can be a rejection day as well. It can look like a rejection day, but it doesn't have to be as significant in terms of size of range, but it can be. So there's a little bit more flexibility with a failed new low. It doesn't have to look like a rejection day in terms of size or stature. It can be smaller, but again, the point is, it is a failed new low. It is a rejection day. And so the failed new low day type can both trigger reversals and be part of continuation patterns. These day types are usually traps to generate more fuel for the existing trend. What I mean by that is, this can either trigger a reversal by itself because it failed to go lower and then the rejection pushed price back above the prior day's mid and then price continues higher. Or this can be part of a continuation pattern where there was a major rejection day here, price goes up, and then there's a failed new low here that continues the pattern onward. So this pattern can be played in and of itself, by itself, or within the construct of a larger trade sequence. So let's talk a little bit more about the background. A failed new low day type begins with strong rejection at a previous day's low or at multiple day lows. So it can be a 1 day low that it rejects, or it can be multiple day lows. So it can be 3, 4, 5 day lows that it takes out and then pops back above. After rejection, the previous low or the rejected level becomes the primary absorption zone. So the level that was rejected becomes the primary absorption zone along with the midpoint of that pattern. So that becomes an important level as well. Ideally, price will close, so the current day's price will close above the previous session's midpoint, which would suggest a strong rejection. Again, failed new low here, and then price turns around and closes here, which is above the previous session's midpoint. Again, that is very, very bullish. Because typically speaking, in an uptrending market, price will stay above the previous midpoint. Any failure to do that, whether it's the previous midpoint of the previous week or the previous month, is designed to do that. As soon as it fails to hold that midpoint is when there might be a change of bias and a turnaround. So again, the midpoint's very, very important. Now, these days can oftentimes precede significant moves in the market and can initiate a trend or fuel one by itself. And so again, you can use this by itself, or you can put it together within the construct of a current existing move. And what I like about these is this could be an add back to your position. So if you've already taken some profits, you can add back on days like this. Or if you've scaled into a trade, this is an area where you can increase exposure after the rejection. So let's talk about measurements here. The range for this type of day is average. It doesn't have to be significantly large, but it shouldn't be significantly small either. So I say somewhere between 75 and 100% of ADR. The low is lower than the previous session's low, and sometimes below multiple day lows. So the low here, that low, is going to be lower than the previous low or lower than multiple day lows. That's a failed new low. It has to be that way, right? You have to be below the previous low, and there has to be a rejection of that low. The close is usually above the previous session's midpoint in the ideal situation, but that doesn't have to be the case. But in the ideal situation, closing above the previous session's mid is very bullish. Location. This one can trigger powerful reversals when paired with previous highs and lows and CLVNs, and can also fuel a powerful continuation leg within an already established trend, right? And lastly, entries. The ideal day trading entry is the previous low on day one, so a rejection of that low. So if price comes in to that low and breaks below it, you can look to engage that rejection right at that point. So sometimes you can anticipate ahead of time. As price is dropping down that day, you can say, hey, this looks like price is going to attempt to push below the previous low, but since we're trending upward over the last week or two, we would look to trap below that low for a shot at continuing higher. So that's why I mentioned the ideal entry point would actually be trapping off of this previous low, or perhaps after the trap, defending the low after a failure. So that is the ideal entry point, but that's not generally the easiest and doesn't necessarily have to be that point. So I would say most of the time when I trade this pattern, say 1 out of 5 times I might get it down here. The rest of the time I'm building somewhere up higher, right? So again, the biggest part of this one is watching for a rejection of the previous low, and if that rejection is strong, it's probably going to continue to push higher. So again, keep an eye on that zone. Let's take a look at an example. Here's an example of Alibaba. So again, a failed new low day type oftentimes precedes powerful reversals. The primary objective during this day type is to confirm the rejection by the end of the day, very similar to the rejection day blueprint. And then you also have the option to enter a position, full or partial, at some point during the day, usually in the last hour of the session. So here's a fantastic failed new low. You can see right here, price opens the day right there at the top of that red box and drops significantly. I mean, when I say significantly, we're talking, 7 points. About 7 handles this thing drops down. That's a pretty good amount. It took out the previous session's low. It took out 2-day lows, 3-day lows. And then by the end of the day had rallied all the way back up to close above the previous session's mid barely. Or at least get very close to closing there. This is in the last hour of the day, in the last 10 minutes of the day. So again, in this scenario, what I did was I entered the market right there at the end of the day for a shot at seeing a pop higher toward 190 to 195. That was the goal, that this thing would pop up and at least trade 187.5 back to this middle portion of the larger range. And another important detail was that earnings was the next morning. Earnings was the next morning, so I jumped in ahead of earnings, betting that it would beat. And not only beat, but beat likely pretty handily. So at the time, the idea was that price would pop initially and perhaps challenge recent highs somewhere between 195 and 200. So that was a strong, strong day right there, the way that played out. That failed new low. You can see here's the midpoint. That's your major entry, right? So first entry opportunity, if the failed new low is confirmed by the end of the day, you have the option to execute an entry in the last hour of the day. That was my approach. The second entry opportunity, if the failed new low is confirmed by the end of the day, you have the option to execute an entry at the absorption zone on day 2, or day 3, or day 4, right? 1 to 3 days, 1 to 4 days after rejection. So my first entry was here, and then if, because we don't know, if price were to pull back here, that would provide a secondary entry or a primary entry for some of you who did not take the entry at the end of the day. So again, very, very important the way that this thing is playing out. The other thing I really like about this is that when you have a rejection day like this and price has kind of gone sideways here, it's kind of built out a major range and tried to go down and failed, which is usually a precursor to expansion to the upside from that range. So I love when there's a failed new low that's developed after some sort of range. Very, very strong. So let's fast forward to the next day. The next day, price opens up and drops right into the midpoint. And again, this is not a completed bar here. This is early in the day, right after the open. So earnings comes out pre-market. I think pre-market price drops all the way down to, say, 170, 171. But by the time the open came back, it was already back to about the 180, 181s. Price opens right there. It drops to and through the midpoint, and then it pops back above it. That is your absorption day or absorption morning. That is when you want to execute that entry. So developing day, when executing an entry during an absorption day at the failed new low midpoint, the day's bar will be incomplete and appear bearish, but ideally will close higher during the day, right? And so when price dropped down, you can see it kind of looks like a spinning top. At the time it was red, and then it pops back up. Now, by the end of the day, as long as it continues to hold above that midpoint, this trade is good. It's good to go. You just let it play out. Now, any failure to hold that zone on the closing basis would open up much more weakness. Ideally, an absorption day will develop after significant rejection day, and this allows you to enter trades at favorable trade location. That's what happened here. And again, once you're in, let the thing play out and see what happens as long as price continues to hold above that midpoint by the end of the day. So this is what it looked like after it continued. The failed new low day type, one of my favorites. It's so powerful, so incredibly aggressive when it really goes. And you can see right here, again, that was a developing day. Price pulled back, it hit the midpoint, it was messing around, but look at how aggressively it continued to push higher by the end of the day, closing well above the 187 halves. It hit 190. The next day, price pops up yet again, hits the 197 zone. And again, whenever price pops in your favor like this, that is a time to take profits, either partially or full profits. But you have to take profits when you're right. When this thing pops higher, you got to take profits when it comes up there, because the risk now is much more, because you have built up quite a bit of profits in here. And if this thing were to turn around, again, weird things start to happen in your mind. You got to be able to take profits when it pops in your favor. So again, what a great move. Number one, we got a great failed new low rejection day here. We got a great midpoint pullback on the absorption morning there with little to no adverse excursion. By the end of the day, it had closed above highs, which is incredible. And the next day, gaps up and runs some more. And again, boom, boom, 2 days, 3 days later, this thing is up nicely. And a great trade only took basically a couple of days. So in this case, I had gotten in at the end of this day and just allowed price to pop higher and took profits on the pop. So again, great move out of this one. One of my favorite setups is a rejection day, but I really love a failed new low rejection day as well. Let's talk a little bit about the outside day blueprint. The outside day blueprint is another strong rejection day. The outside day is a day type that powerfully illustrates rejection, stop runs, and shakeouts. This is a significant day type that oftentimes precedes a strong reversal. So again, all of these are based off of rejections. It's rejecting some prices, some price level, and from there it turns around to head the other way. Because remember, if this is the lows, right, these lows right here are the lows, and price drops forcefully through them, but then cannot go lower, then price will turn around significantly, because now anybody that got short down here is now underwater as this thing starts to come back. The upside buy stops start to trigger, and all of a sudden everybody's running for cover if you got short below that that support level. So again, this is a big time pattern that can be very powerful. So let's look at the background. You have outside days develop at price extremes, like previous highs and lows, very similar to the other patterns we're looking at. Outside days have a range that is larger than average, making the day more statistically significant. So again, it needs to be greater than average. While a rejection day can be 125% of ADR, an outside day may just be slightly bigger than average. Again, I just say above 105%. Anything above average would be good, because if these are average here, then price is dropping a little bit below it and then closing back above it. So the ideal, right? The ideal swing entry is the previous low now. Again, that point right there. If you can identify that area is being rejected early on, you can get in right at that level on a retest before it goes. Or you can wait for the upcoming day for a pullback and defend that way. But for the most part, the previous low is significant, as is the midpoint of the day. So just like with some of the rest of the patterns, if price were to close below the midpoint in any of the upcoming days, this would break the pattern and would suggest a likely run for the outside day low. So again, very important to keep prices above the rejected lows, and then also for price to remain above the outside day midpoint. Now, what makes a great outside day? Let's look at the measurements. Number one, it needs to be greater than average, the size of the range. So from the high to the low, that range needs to be greater than average range. In this case, I say 105%. So if it's a 5% greater than average, that's good enough for an outside day in most cases. The low needs to be below the previous session's low, and that needs to be forcefully rejected. So an outside day, the way that I calculate it, has a low that is below the previous low, and then the close is above the previous high. The close is above the previous high. That is how I define an outside day. Classically speaking, an outside day could be used just by doing the bodies. For example, this open was below that one's above that one, and that could be an outside day. But for me, what makes a more powerful rejection is a rejection of the low and then a close above the prior high. That to me makes a much more powerful outside day rejection. And again, when you see those in the market, they're very powerful, can oftentimes lead to a great bounce back toward value. Now the midpoint here is the ideal swing entry, as it usually is. And again, any open above that point the next day allows you to get into that trade if it were to pull back. if the next day price were to open below that mid, all bets are off, because now any pullback is likely a selling opportunity as it makes a run for new lows. So it needs to open above the midpoint in order to have a potential entry opportunity. Now, location. Where does this occur? These outside days are powerful when paired with market structure, previous lows, and low volume nodes, just like some of the other rejections. Key range lows, those types of things. Those are, those levels are where this pattern really shines. Because again, it's trying to go lower, it fails, and then it bounces back with a vengeance. That's usually a very, very good indication that we're about to bounce higher. Now the entries, again, looking for rejection at the previous low is usually an ideal entry point. But this part is very difficult to really engage unless you see the rejection happening, unless you are able to watch it and see the retest of the previous low from above after rejecting from below. Those are usually good cues that this thing may bounce. That's your great entry. But for the most part, after a day like this, you're entering somewhere off the mid, or maybe even on a retest of the close. So if price were to gap up above the rejection or outside day high, any pullback into that zone provides a buying opportunity. So again, very, very important zone there. So we'll keep an eye on these levels when you see this type of rejection, the previous low and those previous close and high. So this is what it looks like in practice here. This is PBF energy. This was a great rejection. Again, look at the outside day develop here. You have a low below 2-day, 3-day lows, and then the close occurred above 2-day highs. Look at the size of the range compared to some of the bars before. It's a little bit bigger, not significantly bigger, but big enough. And then from there, this rejection day and failed new low is occurring within the midst of kind of a little pattern here, a range that could suggest a major pop is coming. So again, keep in mind, rejection days, very, very strong. Failed new lows, very, very strong. Outside days, very, very strong. This one is almost all three in one. It's clearly a rejection day without the tail so much because it continued to power higher. It is a failed new low. So an outside day like this can also be considered a failed new low. And again, it's an outside day that has a close that's above 2-day highs after rejecting 2-day lows. Usually that would suggest a bounce coming. So very, very powerful the way that this thing plays out. Now, keep in mind, the first entry point is either at the end of the day, last hour of the day on day one rejection. That's the first entry point. Or you can wait for a return to the midpoint, which is the primary absorption zone, or you can retest the previous close from above. That's the secondary absorption zone in this one. So there's many different ways where this one can be engaged. And so whenever you're looking at this, again, what you're looking for is significant rejection of multiple day lows. You want to close above the high. You want it to be rejecting some key level. In this case, there's no CLVN or anything, but it is developing within the pattern of accumulation or at least compression, and that could lead to a pop. So we were looking for a big pop higher on this one. This is what it looked like afterwards, a couple days later. You can see here that price opens the day above the high of the outside day rejection day. So price drops into the secondary absorption zone right there and retests the close in the high from above, and bulls defend it, and this thing races off. So it never came back to the primary entry. Instead, it gapped up above the open, and the secondary absorption zone became the entry point. Now say you didn't get in at the close here, and say you didn't get in here either. Well, there's another entry point here. It's the third entry opportunity, and this occurs when price rejects the previous low here. So this is a failed new low that occurs after the rejection day low. And so again, First entry opportunity can be here on the rejection day. The second one can be here on a range retest. And the third one can be here on a failed new low. Each of those points provides an opportunity to engage this market. Now keep in mind, any close below the absorption day or the absorption midpoint would signal a break of this pattern. However, once you start to develop a secondary absorption zone, you have to now stay above the secondary absorption zone on the closing basis now. So once this became the new absorption zone, now price needs to stay above this level on a closing basis, otherwise this pattern fails. So the primary absorption zone is one thing, but once you create a secondary, the secondary needs to hold. And this is what it looked like here when price continued higher. After a day of rejection and a couple of days of absorption, look to take profits after the first major rally into your forecasted target zone. These pops in your favor are designed for you to pay yourself after building a position. So take advantage of the move by taking either partial or full profits. So remember, great outside day here. You had a hold here, but this right there, again, was a failed new low at the absorption zone. 3 different opportunities to enter that trade, or 3 opportunities to build a position. And then a big pop higher. It pushes through our 32.5 key level. It smashes through our target zone and continues higher. So again, on these pops, you want to be able to take profits. So after price rallies and hits your forecasted target zone, look to take profits either partial or full, depending on your trading plan. Typically speaking, it usually depends on how much more upside something can have, or whatever the case is. But I mean, if this one pops into your favor, you got to at least take profits on 1/3 of your position, or half your position, or maybe 3/4 of your position, and then let the last portion ride for more highs. This one was a great pop off this move. 1, 2, 3, 4, 5 days, it was way higher. But if you wait another 2 weeks, 3 weeks, 4 weeks, this one was way off to the races for the next 2 or 3 months. So this was the beginning of a multiple month rally that occurred. And again, we caught it right at the beginning. A great, great move based off of that outside day rejection day. Now we're going to talk about the stop run day blueprint now. The stop run day is an aggressive trend day that can lead to some of the most powerful days in the market. Absorption days typically develop after a stop run day. Sometimes 1 or 2 days it can happen, but for the most part, a stop run day is significant. It is a huge day that can lead to major, major continuations in the market. So let's talk a little background on this one. Number 1, stop run days are price discovery phases that tend to trend at an aggressive pace. So you don't really know it's a stop run day early on, but once price breaks through these highs, things get very aggressive, and now you're trending up like this during the day. That is a stop run day, when it is just aggressively pushing higher and it's not pulling back, and it just continues to push higher, eventually closing near the session's highs. That is an aggressive stop run day. Now, stop run days also tend to be the biggest days in the market. These are the days that have ranges exceeding 200 to 300% of average range. So if this is an average range over here, a stop run day will easily be 2 times the size of average, sometimes larger, 2.5 times, 3 times the size, or more. So these are the biggest days in the market. A stop run day is the biggest day in the market. So you want to be able to identify it. You want to be able to ride the coattails of that move, because more of a continuation could be ahead. Now, the stop run day, in order to find a target for the day, you want to identify the midpoint of that day, and the midpoint, or the forecast where the midpoint will be by the end of the day. So, for example, if this is a major low that occurs and it takes out these lows and turns around and starts to push through the prior highs, at this point the day's range is only this big, so the midpoint is somewhere here. But then as price continues to push higher, this midpoint creeps higher and higher and higher and higher until by the end of the day it hit this high, and now the midpoint is right at where the stops came out. It is uncanny how that happens, but it does, and sometimes it is so precise. It is incredible. So whenever you want to take a stop run day, or you take a trade in a stop run day and hold it to the end of the day, it's easy to forecast that target. So a stop run day target is when you take the developing stop run day's range below the previous high and forecast this measurement higher from the previous high. So if you have an indication that this might be a stop run day, you just take that low from this high. So you subtract this low from that high, and then you project that difference higher from this high, and that gives you a rough stop run day target. Again, uncanny how that happens. Now, after a stop run day, it's also important to understand that after you get a major stop run like this, the day after a stop run can tend to be a counter trend fade day, which means the next day price may reject that high, in which case now we're pushing back and trending lower as a counter trend fade day back to or toward the midpoint. And that's usually an overnight move or a morning move. And then once price hits that zone, you now have the retest after stop run, and now bulls are going to be looking to defend the midpoint, the breakout point, the prior highs, defend for a continuation higher. So that's how you would look at a stop run day in terms of measurement. You're looking for a measurement from the low to the high, and then you forecast it higher. You're looking for a daily range that's 200 to 300% of ADR in many cases by the end of the day. You want the close price. You want the close price to be above the previous session's highs, and usually the close price will be in the upper 10 to 15% of the day's range, the daily range. Which means if this is your high and this is your low, that's your range. Price will usually close in the top 10 to 15% of that overall range during the stop run day. So what I usually mention to our traders in the trading room is that if we get a push through this zone, hold on to for the rest of the day as long as it holds above that mid, because by the end of the day it's going to likely close near the highs of the day. And so you can maximize that move throughout the session till you hit that stop run day target. So the range is greater than 200% of ADR. The low sometimes can coincide with a failed new low, which sparks a major move higher. The close should be above the previous session's highs and usually closes in the upper 10 to 15% of the day. The midpoint is usually at or around where the stops came out of the prior highs there. That's usually where it is. And the location usually develops after rejection and or absorption, and is powerful when paired with CLVNs as well. The entry points now, the entry points for this one again, if you see that there is a rejection happening down here, this could be the ideal entry for a continuation higher. The secondary entry point is after the breakout, retesting the breakout point and defending that area for a continuation. That is another spot. So look to defend retests of the previous high from above. This entry can also double as a day trade. So all of this can be played as a day trade, or you can position yourself on a swing basis as well. So those are the major points right there. And again, anytime you have a stop run day, in effect, you look to hold on to the end of the day because it can be significant. But one thing to keep in mind is that I look to take some profits, at least half profits or maybe full profits by the end of the day on a day like that if I'm trading as a day trade, because inevitably the next day price will turn around and pull back, and if you're still holding that trade, it can feel pretty hairy trying to hold on and watch all those profits disappear. So take profits when price pops in your favor. That's why the market is what it is. It's designed. You're designed to pay yourself when price pops in your favor after you've built a position. That's just what you have to do. Otherwise, you risk giving it all back. Here is an example in Phillips 66. So this is a great stop run day right here. Again, it perfectly illustrates the exact same points that we talk about. In this case, price broke through not just the previous high, but multiple day highs. 1, 2, 3, 4, 5, 6 day highs here and more. But up here, these were the highs that price was taking out. And so in this case, if you take these highs this way, and you take that low and take that measurement, you take that measurement and forecast it higher, and you get that point right there. Right? That's about what you would get. And so again, anytime you're looking at a stop run day target, you can take the previous high to the low, and it's going to give you about a measurement that takes you from the previous high above. Right? Now, that's the previous high though, right here. This is the previous high, but this is the breakout high. So it's whatever the breakout high is. Sometimes it's the previous high. Most cases it is, but sometimes it doesn't have to be the case. So again, what is the breakout level that the stop run day is starting to push through? That's the level where you would use to forecast your measurement. So remember, the stop run day is the most aggressive trend day the market has to offer. The primary objective is to confirm the day as early as possible, usually in the intraday time frame, and then look to execute an aggressive position to take advantage of the day's forecasted price range and the subsequent swing move to come. The stop run day can be traded as a day or swing position. Remember, this day can be traded as a day or swing, so when price pops up here and hits your target, take some profits. After price rallies and hits your forecasted stop run day target, look to take profits on the entire trade if it's a day trade, at the highs of the day or at that stop run day target, or take profits on half the trade if it's a swing trade, with the intention of adding back that half the next day. So say you got into, I don't know, 200 shares of this one and it continues higher, or 10 contracts of options and it goes higher. Take half here, and then when price pulls back to the absorption zone the next day, add it back here, and now you've kind of squeezed more juice out of that lemon. So again, a very, very solid approach to engaging a stop run day is to take some of those profits at the end of the day and then look to add them back when price pulls back to the absorption zone the next day. Right here again, midpoint retest. Look at the open the next day. The open was above it. So if the open is above it and drops into it, it's a go to watch for a buy opportunity, right? But say price had not opened there. Say price had opened here. If price had opened below the midpoint, it's a no-go on the upside move. And in fact, it may actually be a sell opportunity instead. It may be an opportunity for you to flip direction. So when if price were to gap down and then rally into the zone, it's probably an opportunity to sell it back down. So again, midpoint's very important. The absorption zone needs to maintain held, and you can see it held for several days and eventually continued higher. So again, great opportunity here when things start to really run and you see the stop run day early in the day. It's probably going to stay that way for much of the session. So the stop run day is an aggressive trend day that can lead to some of the most powerful days in the market. Rejection days and absorption days help fuel these days. This first opportunity here, if the stop run day is confirmed early in the day, look to execute an entry at or near the breakout point, usually the previous high. This can be a partial or full entry, but look to be more aggressive on this type of day if confirmed. So again, on those stop run days, where I am very confident that this is a stop run day, let's get in on that one and let's hold it for the rest of the day, I will usually allocate my most aggressive trades for that type of day. Secondly here, if the stop run day closes in the upper 20% of the day's range, then a second entry opportunity presents itself upon a retest of the absorption zone on day 2. So typically speaking, if you have a stop run day, you're going to want price to stay closed in the upper 10, 15, 20% of the day's range. If so, then any pullback offers an opportunity for you to buy it off the absorption zone for a continuation higher. And that absorption zone, again, remains intact until it proves otherwise. So the absorption zone will continue to remain bid until the market sees a daily closing price below this zone. So even the pullback here offered another opportunity for bulls to defend and continue this thing higher. So a very good example here with regards to stop run days. All right, well, now that we have a great understanding of our day type blueprints, the rejection day blueprint, the absorption day blueprint, failed new low blueprint, outside day blueprint, and the stop run day blueprint, those are very, very powerful. We now have 4 trade sequences that we can use in order to help us find and trade high probability opportunities in all markets. The 4 trade sequences that we are going to discuss are the rejection day sequence, the stop run day sequence, failed absorption sequence, and the accumulation sequence. The first one here that we're going to discuss is the rejection day sequence. This blueprint illustrates the rejection day trade sequence, including identifying key absorption zones and entry points. Use this sequence when a rejection day develops. So at first we were looking at just one day. This is one rejection day. This is 1 or 2 absorption days. This is 1 stop run day, another absorption day. This right here is a continuation day, right? So we're stitching together. We're combining multiple days to create a trade sequence where we understand where every entry point is for that trade, every potential absorption zone, and every failure point. It's very, very important because, again, the market isn't just about hitting a level and then taking off and never coming back. Oftentimes, in order to fuel a move like this, it needs to build out for a day or 2 or 3 or 5 to build enough energy before that can happen. And if you can understand that process, understand where each and every entry point is, you'll be much better off. So let's take a look at the various components of a rejection day sequence. Number 1, the rejection day. So when a rejection day develops, like this point right here, our goal is to establish a new position after the rejection day is confirmed. So entries can be made on the day of a confirmed rejection day or in the coming days at the primary absorption zone. So when this day develops, we can take a trade in the last hour of the day. We can even do it earlier in the day if we really truly believe that the rejection day is a rejection day as it develops. Sometimes I'll get in down here before I know it's a rejection day because it looks like rejection is developing. So sometimes that can happen, but that is few and far between for the most part. Instead, let the day play out, and if in the last hour it's still showing rejection, you can look to enter at least a partial entry in the last hour of the day. The primary absorption zone is number 2. That is the spot here where you have the midpoint of the rejection day and the level that was rejected. That becomes the area where bulls will want to defend. Now keep in mind that price can drop below that level over the course of the next couple of days. We just need it to pop back above it. So if price drops below it early in the day, it's okay. You just need it to pop back above that zone. If price drops below it and then it can't get above and it starts doing this, then yeah, that's probably toast, right? And then it starts working its way down this tail, and all of a sudden you're down here. That's not what you want to see. You want to see the market bounce or show some sort of life off the absorption zone on the first test. So the primary absorption zone is the zone between the rejection day midpoint and the rejected price level, right? And now bulls will use this area to defend and execute positions over the course of the next several days. A daily close below this zone will ruin this trade and trigger a stop run to the downside, and thus positions must be exited at such time. So say I was long here, I got in here, say I got in here as well, and even here. You know, I did a third entry here, I did a third entry here, and I did my last third here, and now I'm fully positioned. If on day 4 price starts to break through this low and we're now trading below the midpoint here and it's the last hour of the day, I don't really have to wait till the end of the day to know that we're probably not going to close back above that mid. That would be a chance to go ahead and get out of that position. So again, that midpoint is very, very important. Number 3, absorption days. So add to your position or establish a new position at the absorption zone on these days. So again, it can kind of be an art trying to figure out whether you want to enter at the last hour of the day here, or should you wait to see if you get a much better entry at the midpoint. An absorption day is going to allow you to enter at the midpoint if that occurs. But what if price opens the day here the next day? Then you're going to have to come back and try to get a range retest entry, and you're never going to get that entry, right? So sometimes there's cases where, again, I get in at the end of the day because maybe there's earnings coming up the next day, or maybe it looks like a significant rejection, and the next day it opens here and just runs. And now you're happy you at least got some, because if you were waiting for the next day for here, you'd be out of luck now, and now you're chasing. So oftentimes I like to spread out my entries, a little here, maybe some here. I could also do it here, right? There's various points where I know how to engage this pattern in order to add exposure or reduce exposure if certain things were to happen. Number 4, failed new low. Add to your position or establish a new position should a failed new low develop. Right here, that's a failed new low where price pushes below these last lows here and starts to pop back up. I'm constantly watching for that. If you have a rejection day here and you have an absorption day on day 2, you know, this is day 2, this is day 1. On day 3, I'm usually looking for a failed new low. Or day 4. I'm usually looking for a failed new low. If price pulls back, I'm looking to trap at a failed new low for a shot again at pushing this thing much, much higher. So failed new low again gives you another opportunity to add to your position or establish a new position. Now stop run day. Again, this is a great day right here. If you have built up a position and now you get the stop run day, this is the day where you're starting to get paid. So you add to your position at the breakout point or lower if you can get it on this type of day, and then take partial profits on the close. So say, for example, you had taken a partial entry here and a partial entry here, and then you start to see an aggressive stop run day develop. You could double that trade now here, and when price closes the day higher, take off whatever you added during that part to take partial profits, and then you can add back to it here after the retest here. So a very, very aggressive day that occurs here. Now, after you get a stop run day, a new absorption zone typically reveals itself. The secondary absorption zone, that's 0.6 here. So this is the primary absorption zone after rejection. Primary absorption zone, this was resistance. It pushes through that area, and then when it comes back, that becomes the new secondary absorption zone. And now price needs to remain above this level now. So we transferred from needing price to close above this absorption zone, the primary on a closing basis, to now, after the new secondary absorption zone has been developed, price now needs to remain above that level on a closing basis moving forward, because now a failure to close above this level, if price were to close through it here, usually will lead to a push through this level and lower. So it'd be a failed move. So now that you have the new secondary absorption zone, price needs to stay above that area. Now this day right here, number 7, is called a stop run day, or a retest after stop run day. You have a fade after stop run day as well, so you can see this high right here. Typically speaking, after a stop run day, you can watch that high pre-market or watch that high right after the market opens, and any rejection there oftentimes leads to a pullback into the stop run day midpoint. And then from there, this is the retest after stop run. This is an opportunity to add back to your position and defend your position for a continuation higher. Now keep in mind, just because you have all of these various entry points, you got an entry point here, an entry point here, and here, and here, maybe there, maybe here, maybe here, right? All of those areas provide entry points to add to your position along the way. Just because there are all those entry points doesn't mean you have to use every single one of them. I usually will use about 1 to 3 of those. depending upon how things are developing. Usually I'm looking to engage on a rejection day here or here. That'd be 1 or 2. And then I'd be looking for a failed new low. That's about 3. If more develops from there and I've taken profits here, for example, on some of that trade, then I'm looking to engage here and keep it going, right? And so again, when you see this type of sequence, you'll start to become familiar with where those entry points are, where the add back points are, and where the necessary points that price needs to stay above in order for the continuation to continue to play out. Lastly here, day number 8 would be a continuation day, or point number 8 would be a continuation day. A continuation day is when price just continues higher, pushes through those highs, and now you're getting paid again. Those are great days, and ideally this type of day starts you on a path toward your primary target. So you're either going to reach it on this day or reach it in the days to come very shortly, and that is a day where you like to take partial profits. So many of you will see me engage an entry here in the trading room. You'll see me maybe add to it here, and then once price pushes up and really gets that major pop in my direction, you're seeing me take profits at highs after a major push in my favor, but I'm still holding partial positions in case things continue higher, and I'm still keeping the door open to adding back if the situation suggests that I should do so. So again, these are the various points of a rejection day sequence that are very, very important to engage. Number 1, major entry on this day where you can establish a full or partial position. On entry number 2, you can add to the position or establish a new position at the absorption zone, but price needs to open above the midpoint rejection day, or the midpoint, right? The midpoint of rejection day. And then over here, you can add on entry point 3 on a failed new low. You can add at entry point 4 on a stop run day breakout through the prior high. You can add here entry point 5 on a retest after stop run. So there's various points where you can engage this trade, but everything breaks down if price can no longer hold above that zone on a closing basis. So let's take a look at a rejection day trade sequence here in Macy's. So the rejection day is the first day of the rejection day trade sequence. Here you go. That's a great looking rejection day. The primary objective during this day is to confirm the rejection day by the end of the day, with the option to enter a position, full or partial, at some point during the day, usually in the last hour of the session. So I remember looking at this one. I found it in the last hour of the trading day using a scan, and we brought it up in the trading room and said this was a really good one. I like Macy's for several factors. Number 1, you have a major CLVN right here, major composite low volume node. You can see the volume profile crashes in here and then pops back up. That's a low volume node. And you can see clearly it's an area where the market does not want to trade. It is clear rejection. That's why it's a CLVN. And so for price to come and pop above it here and then continue to hold it and continue to hold it is very powerful. And then here we are again forming a major rejection just shy of that level, which is perfect. That's awesome, right? That's exactly what you want to see, is a strong rejection day, and you want to have a major area of support to lean on, and that CLVN does that for us. So the rejection day here develops above the 2770 CLVN, and quarterly earnings are in 3 days. So we're expecting a pop into earnings with a shot at reaching our forecasted high probability target zone between 32 and 33. So again, we're forecasting from this low, because if this is a rejection day, then we can look at this low as being the low for that move. Maybe not the low forever, but the low for the next 1 to 3 weeks, right? And so if that is the low, we can use this low to forecast higher average monthly range and 75% of average monthly range over the last 10 months. And that's how I get these targets. High probability targets. Very, very reliable. Great, great targets, and they make everything much, much easier. And so when price forms this rejection day, day 1, we now have the absorption zone right at the midpoint of that level. And that is a strong level to watch for a pullback and defense. If you look over here, here's a rejection day sequence that played out. This was a nice rejection day here. It was also a failed new low, so 2-day lows and dropped below it but did not close above the midpoint, but still a rejection day. You can see here this is an absorption day with the midpoint retest. Here's a stop run day there. This is a retest after stop run and a continuation, and eventually price pops all the way back to resistance. So that was a great rejection day. This is another one that's developing here. And again, the idea here is to confirm that you have a rejection by the end of the day and look to enter something, either full position or partial position at the end of the first day, or look to enter that position the next session if price opens above the rejection day midpoint. So this is what day 2 looks like. Day 2 has an open above the midpoint. It takes out the high briefly and pulls back to the absorption zone. And again, that's exactly what you want to see. That pullback right there allowed another entry opportunity. So that's your second entry opportunity. So you can look to execute an entry at the absorption zone on day 2 at or near the rejection day midpoint. And this can be either a partial or full position. So if you got in some here, you can add some here. If you didn't get in any here, then you can look to add a little bit more size when it pulls back to this absorption zone. Now I always mention here at or near the rejection day midpoint, because price won't always come perfectly to the midpoint. Sometimes it does, and it's actually quite uncanny how it can pull back right to that midpoint time and time again. But it doesn't always have to be that way. It can come close, but no cigar, and pull back. So again, that's why I say it's an absorption zone. It's not just one price, it's a zone. And so you want to be able to identify the zone, and when price drops into that zone, look for signals that it is showing strength off that area, because that would be a great spot to enter that trade at the best favorable location ahead of what could be a great reversal ahead. So we have a rejection day right here, we have the absorption zone, and now we have the absorption day coming into the zone for an entry. So 2 opportunities to enter that trade so far. And now when you look over here at Macy's and you fast forward another couple of days, after this entry, you can see price gapped up on day 3 after rejection here, and then filled a little bit back downward. So it wasn't a great runaway day, but one thing I look for to keep my heart rate nice and low is I look to see a pattern of higher highs and higher lows day over day. So even though this one gapped up and filled, I look at it as value was still shifted higher on that day. Higher highs still achieved, higher lows still achieved. I'm still going to hold this position. And then it's on the next day where you get a third entry opportunity. So on this day, you get a failed new low when price drops through 2-day lows and retests the primary absorption zone of the rejection day, which is again defended by bulls in this case. So waiting for confirmation on this day and ability to reestablish acceptance back above the previous low offers an opportunity to execute or add to a position. So there's a couple of ways to think about this one. Number one, just because price is in this zone, you could look to add to that position because it came back to the absorption zone. But keep in mind, when price is in the zone, it's going to look bearish. Like this is a red bar, it's going to look like this. And with multiple lower highs and things, that may not look like the best. So usually, again, I just wait. Wait and let it reject. Let it do its thing. And if the market starts to reject that point, as it does, then you can look to execute an entry based off of that rejection day. So a failed new low develops, gives you another opportunity to either enter at the absorption zone or at the end of the day of the rejection day. So you don't necessarily have to get in at the absorption zone here on this day. You can, but if by the end of the day it looks like this, and you know, hey, that looks like a great failed new low, you can add there and have a much higher, be more confirmed move and have a much higher probability that this thing may pop. So again, several points to be able to engage this move. Number one, the rejection day. Number two, the absorption day. And number three, the failed new low. Now again, this is a trade sequence, right? And this is what I mentioned before. Trade sequences are just several day types combined together that build out and then fuel the next move. That's what you want to see. 1, 2, 3 days of building out before a big type of move occurs. And that gives you an opportunity to enter this trade. So this is now 4 days. You have rejection plus 3 days here where it's building out. And now ideally, you'll see a pop higher to come. And that's, again, where you can take profits. And here we are. This is what happens when earnings comes out. Again, price with a great rejection day. Nice midpoint retest in the absorption zone. A failed new low that develops. But look at where it was by the end of the day. By the end of the day, it had closed back above the previous mid. That's very strong. Then earnings comes out. The next morning gaps up and runs and hits our target zone between 32 and 33. And again, after earnings, and you get a major pop up, and you've built your position over the course of 1 or 2 or 3 or 4 days, you have to take profits. Don't get greedy. You cannot get greedy, because if you are greedy and want to hold on, the market will punish you at times. It will come all the way back down and take it all from you. So when price pops in your favor, take profits, either partial or full. Again, look at this big move here. Big move up. You could be feeling like you're on top of the world, and you don't take profits, and it takes it all the way back. It gives it all the way back. This thing, boom, pops up. You feel like you're on top of the world. It gives it all the way back, right? Take profits when this thing pops in your favor. Reward yourself after a great entry in that trade sequence. So again, a great move. Again, after building a position during the first few days of a rejection day trade sequence, your primary goal is to take profits on the first favorable pop into your forecasted target zone, while looking to dump the trade if price fails to hold above the absorption zone on a daily closing basis. So a big move up, a great continuation. That is about as perfect of a trade sequence as you'll see. Great rejection day, great CLVN, great trend overall, great midpoint retest, solid failed new low, and a big pop on earnings, and you're able to pay yourself. Great trade, great move on that one, and a great trade sequence. Alright, in this section we're going to discuss the stop run sequence. This blueprint illustrates the stop run trade sequence, wherein the entries can serve as both day and swing trading opportunities. Use this sequence when a stop run day develops. So again, what we're looking for here is for any ideas that we get some sort of stop run day where price is going to run through recent highs and continue in a price discovery phase throughout the session, triggering a high range day where the range can be anywhere from 150 to 200% of average, and many times well beyond that. Again, when this type of day develops, typically speaking, you want to be more aggressive about your entry, more aggressive about the level of exposure, because in this type of day you can get major moves that occur, and they can continue trending higher throughout the session, closing near the session highs. So again, when that happens, there's a couple of entry opportunities that we're going to look at in terms of identifying where to get in, and then there's also the counter trend idea. There's the retest after stop run, failed new lows, continuation days as this thing continues to progress. So let's go ahead and start with number one over here. First of all, you have your stop run day. A failed new low offers the earliest opportunity to establish a new position, while a secondary entry occurs upon expansion through the breakout point, previous highs. So a failed new low. Now this isn't always the case, but sometimes price will drop down through multiple day lows, reject, and turn right around and trigger a stop run day in the opposite direction. So a failed new low, again, would be the earliest and ideal entry idea for that type of opportunity. Now, again, only a small percentage of trades fall within that category because most times you don't really know it's a stop run day until you're really breaking through prior highs. But there could be an entry opportunity here where you enter the trade, and then by the time this thing is breaking through highs, a stop run day then develops. And as that stop run day develops, should you get in at the earliest entry, you could be looking to add exposure upon a retest of the breakout point from above. So in this case, price would break through these recent 2-day highs, and when price returns to retest the breakout point from above, that's your entry to continue pushing this thing higher. So again, any failure to hold that point throughout the session or a close back below that session on a daily closing basis would negate that day. So this type of day needs to close with a high range day. It needs to close near the session highs. The midpoint needs to be at or around or at least above the breakout point, and that again would constitute a very bullish stop run day. Now the primary absorption zone here, this zone is between the stop run day midpoint and the rejected price level. That right there becomes the absorption zone. So this is the rejected price level where we see a major push through that area. The midpoint eventually closes at or near that point, and so that becomes the primary absorption zone. Now, after price sees a significant stop run day and closes near the highs of the day in the upper 10 to 15% of the day's range, oftentimes you want to go ahead and take your profits, at least on partial position there. You want to be able to take some of those partial profits on after an aggressive trend day up, because what tends to happen is the next session, or perhaps after hours or in pre-market trading, you'll want to watch the stop run day high, because any rejection of that stop run day high typically opens the door to a counter trade move back toward the midpoint of the stop run day. That is your one counter trend opportunity. So for example, if you traded this on a day trading basis and were able to take a good profit out of that move, the next move could be looking to play a rejection off that high back to the midpoint. That's usually a trade that happens by the morning. So overnight or after hours or even after the market opens during RTH, there could be a rejection at that high that leads to a pullback back toward the midpoint of the stop run day. That right there is a short-term counter trade idea, followed by the retest after stop run. So this is a stop run day. This is the retest where price retests the midpoint and the breakout point from above. That retest after stop run day is very, very powerful. Bulls want to be able to defend the breakout point at all costs. And again, that could be defended over the next 1, 2, or even 3 days. And price needs to continue to close above that absorption zone. Any close below that zone on a daily closing basis would suggest a failure of this pattern and a likely stop run in the opposite direction. So again, retest after stop run looks to defend the primary absorption zone from above, and so does the prior day or the day after a rejection of the prior day's low. So prior day low, that could be a failed new low that gets you in as well. These two are absorption days, stop run day. This is a continuation day right here, and during the continuation day, again, you want to be able to take some profits at or near the end of the day here as this thing pushes higher toward your primary target. So you want to be able to pay yourself along the way. So entry number one, again, can be kind of difficult to get into the trade like that, but any rejection of lows here, a retest of the previous low from above could be an opportunity to get in. The next entry point would be a retest of the breakout point from above after a stop run occurs through it. And again, sometimes that will be your primary entry on this type of day. Your third entry opportunity will come here and here, so 3 and 4, in terms of the primary direction. So on this pullback here at the midpoint, that becomes your third and fourth opportunities to enter the market. This entry, labeled entry 3, is a counter trend trade. So this is up to you whether you want to take a counter trend here, but the opportunity is there. Sometimes this can be traded by itself as a quick day trade. And sometimes, for example, if you are long stock or long the futures or long the underlying, on this counter trend move here, you could look to buy a put to take advantage of this pullback, take the put off right here, and then add to your position here for continuation higher. So there's various ways where you can engage this type of opportunity as it develops. Let's go ahead and look at an example. This is Roku, and Roku had a fantastic bounce off of the $30 level. This was a major CLVN in the chart. Price had dropped significantly from as high as 52s and then recently here from 40 all the way down and dropped into this $30 level. We were watching this LVN very closely. The first day showed some strength, but by the end of the day closed lower. The next day had a tail at the upper end. After that, we had a breakdown and a pop back up. Not quite a stop, not quite a rejection day, but very, very close. And then the fourth day here, we have the stop run day. You can see here, price actually opens the day at new lows, hitting 29 evens, and that was below the previous 3-day lows here. And then price aggressively rallies back up, aggressively rallying through the highs and closing at the highs of the session, again in the upper 10 or 15% of the day. This looks like it's the upper 3% of the day. So that's a pretty aggressive rally. The midpoint didn't quite get to the highs here, the 2-day highs, but at the same time it is a high range stop run day, and that midpoint is still very, very important. Additionally, what's most important in this chart is that CLVN, the $30 CLVN right here. So when this happened live in the trading room, I mentioned that this was the day we've been looking for. We had been looking for a bounce off the $30 level for the prior 3 days. We never got the rejection sequence that we were looking for, but on day 4 we got the stop run back up. Price opened at a low at 29 and just aggressively rallied throughout the day. So in this case, what I mentioned to our trading room was any pullback now, even as deep as 30 or into the midpoint, provides an opportunity to defend for a shot at pushing this thing higher toward 39, and over the course of several months, perhaps you even double the price of Roku. So again, this right here bounced higher and closed near the highs. So a stop run day usually produces the biggest moves the market has to offer. You can see how big this range is compared to some of these other ranges. These are not bad days here, right? These are pretty decent sized days, but this day is outsized compared to all of those others. Big time day. So as such, being able to diagnose a potential stop run day before it happens can become very beneficial in being able to position yourself ahead of the next big move, or perhaps protecting yourself if that stop run day is against you. So again, it's very important to understand when that type of day may develop. These days can be played as day trades or swing trades. So again, if you see this thing aggressively rallying on this day, you can buy it early and hold on to the rest of the day, because you know that in most cases this type of day will close in the upper extreme of the day's range. Now, the first entry opportunity, typically a stop run day will experience an aggressive trend day structure. Look to execute a full position upon a retest of the previous high from above, with the option of taking profits in the last hour of the day, partial or full. So again, when this thing starts to rally big time here, you could be looking to retest the prior highs from above. You could have been in on a rejection on these lows, wherever the case is, but the idea is to get in and look to hold it throughout the session. And being a little bit more aggressive about your level of exposure as well. This is somewhere where you may want to go 2.5% of ADR, or 2.5% of your core equity. You could be looking to be a little bit more aggressive, depending on what you currently hold in your portfolio or what you're currently in position in. But for the most part, this is a day to be aggressive. Now, in terms of the stop run day here, initially this develops with a failed new low. And that's why you have an early shot at jumping in the trade early on. But again, that's not always the case. And so even if you find this at the end of the day after the market closes, there's still an opportunity to enter at the absorption zone the next day. And that provides a great opportunity, again, to get into the trade ahead of the next pop higher. So at the absorption zone here, bulls would look to defend the absorption zone on day 2 after stop run, which offers ideal trade location for swing longs. Bulls will want to add to positions or establish new positions at this zone in the coming days. A daily close below the absorption zone breaks this trade opportunity. So you want to be able to continue to hold above that absorption zone. All right, so here is the next session. The next session, price gaps up. And remember, we have fade after stop run, right? So here's your stop run day. It closes near the highs of the day. Here's your high. And look at the next day. The next day gaps up, fails to hold above the high, and your counter trend move occurs right back to the absorption point and toward the midpoint. Again, that's your counter trend fade right there after a significant stop run. So again, say you're long in this trade, you aggressively get in here, and at the end of the day you take off half the trade. You could be looking to add that half back on a pullback. Additionally, you could also look to put on a put or some counter trend opportunity so that you can take advantage of the pullback while you're still holding some of the long position, right? Because ideally what this pullback is doing is it's giving you an opportunity to enter at a better price ahead of the next move up. So the second entry opportunity here occurs at the absorption zone on day 2 at or near the rejection day midpoint and the breakout point. This entry can serve as a full or partial entry. So again, you can look to defend here and add back to the trade, or this could be your primary entry. You may not have even gotten into a trade here. This pullback right here allows you an opportunity to get in either partial or full position ahead of the next move. Let's talk about fade after stop run for a moment. Look to the stop run day high for signs of rejection the next morning, as a fade opportunity may present itself back to the stop run day midpoint / breakout point. Now there's 3 options over here when you have that type of move. Number 1, option 1, execute a standalone short position should a rejection occur at the previous high with a target as low as the mid. So in this case, your first option, even if you're doing nothing else, if you see a major stop run day up and there's a rejection at this high, there's an opportunity for a standalone short back toward the midpoint of the stop run day. Now I wouldn't overshoot the midpoint. Sometimes if price breaks through that midpoint, then it's going to give it all the way back. But in most cases, take what you get. If price gets close but not all the way to the mid, take what the market gives you, because remember, it's a counter trend fade after a primary stop run day up. So for the most part, the market's likely going to continue up, so you don't want to overstay your welcome on a counter trend move. Option number 2, execute a short position that acts as a short-term hedge to protect a long position, thus counteracting the pullback. So say you got into the long trade here and you know that there's a good potential that this thing will pull back, giving back some of your profit. Well, instead, again, look to take some profits here at the end of the day, but put on a counter trend fade here so that you can take advantage of the pullback, and then you add to the primary position once it's done. So there's an opportunity here again to, for example, put on a put. So you execute a put, a long put strategy there, where price comes back, take the put off here, add back to your primary position on the pullback, and now you're running higher. So again, being able to anticipate those events ahead of time allows you to prepare for those types of entry opportunities. Option number 3, scale a portion of a long position in the last hour of the stop run day and then add back to the position at the absorption zone upon a retest on day 2. So again, option 3 says, hey, we're long here. let's take some off the table here, whatever the case may be, half the trade, a third, maybe 3/4, maybe all of it. And then when price pulls back, then look to add back. And so basically you're ignoring the counter trend fade. And instead, you've taken off much of the risk here. You've left a little bit of risk on just in case this thing does this. But on any pullback, that's where you add back. So again, many different ways to engage this type of opportunity. But basically speaking, you want to be either in, you want to be able to take some profits, and then either protect yourself on the counter trend and or defend the pullback to add more exposure ahead of the likely squeeze to come. Here's the next slide here. This is the next day. The next day is a failed new low. So basically price drops down, it gaps down from the close here, it gaps down to here, it drops through the prior low and hits the stop run day midpoint. Once it hits the stop run day midpoint, it bounces, and now again that becomes the third entry opportunity. And when this happened live, this was actually my entry. So when price, I was watching for a failed new low, I wanted to make sure, because remember this stock had dropped from 40 to 29 in the matter of 3 to 4 weeks. So it was a pretty significant drop. I wanted to make sure that the LVN was going to remain intact. And so when price came back for a failed new low, that was my entry. And I entered in many different ways there using options. But that was a great failed new low right off the midpoint. And again, that gives you another opportunity. So day 3 after stop run usually involves looking for a failed new low, which could provide another entry opportunity. Execute an entry upon a rejection of the previous low at the absorption zone. This entry can serve as a full or partial entry. Again, with this one, I like this level so much. I like this name so much. I thought that we had a great shot to bounce back toward 39s. And so in this case, I actually entered 100% position on that failed new low ahead of what would likely be a bounce ahead. So let's move on to the next slide. And this happens to be the completion of the move. You can see after the failed new low here, price pops up the next 2 days. Very, very nice. And then you notice here, it pulls back and another failed new low develops right on top of the absorption zone, the initial absorption zone, pops up again, and then pulls back and another failed new low occurs. And then we see a major pop up after that, a major gap up. Price rallies and continues higher, reaching as high as 37 and change, and eventually even goes all the way across the 39s and then some. So again, as I mentioned before, when price pops in your favor, the first major pop, that's when you want to take profits. So price pops higher after earnings. There was earnings on this day here, allowing for an ideal opportunity to take full or partial profits after building a position during the first few days of the stop run day trade sequence. And again, that is where I took off profits on a majority of my in-the-money trade, and then I still had a put spread that I was holding at that point as well. So a great move, and again, a great stop run day sequence. It had everything. It had failed new low, a high range stop run day, the fade after stop run, you had the retest after stop run, you also had a failed new low in the absorption zone, and then multiple failed new lows that allowed you to add exposure if you wanted at that point. Each of those opportunities provides several entry and re-entry opportunities throughout the life cycle of this sequence, with each one revealing itself as a failed new low, right? So every single time that failed new low occurred, it was an opportunity to add to your position or jump in the trade either way. So again, a great move, a great pop, and as soon as this thing pops up here, take the money and run. A great stop run day there. Alright, in this sequence here, we're going to discuss failed absorption. The failed absorption sequence is a powerful sequence because this is when the stops come out. You have market participants who have been building a position, looking for a continuation in one direction. But when those market participants don't get paid, that's when a stop run can occur, and those market participants start to jump ship, and then a major collapse occurs. This can be a very, very powerful trade. So continue to watch when a rejection day sequence fails, because that's when a significant stop run can occur. So let's talk about this a little bit more here. Number one, rejection day. So this is your rejection day, right? You have your number one rejection day, a major breakthrough recent lows, price rallies, the midpoints at the zone here. That's your primary absorption zone. And so typically speaking, those participants will start a trade sequence for the rejection day, right? And so, for example, I could get long at the end of the day here, and then I look to add my position there, and then I add to my position should a failed new low occurred, and now I have, say, a third entry, a third entry, a third entry. I'm in a full position, and now all I need to do is get paid. All I need to do is get paid. But where are my stops, right? Because this is the midpoint, and that's the area right there where I need to continue to see price hold. If there's a daily close below that zone, remember, we jump ship, because we know that if you close below the midpoint of a rejection day, 9 times out of 10 you're going to come take out those lows. 9 times out of 10. So that tells you right there that when bulls get in and they defend this area, the sell stops start right below that zone, and they continue all the way through prior lows. And so when price fails up here, for example, after several days of absorption, and you see a failed breakout at the secondary absorption zone or through prior highs, if price pushes up through those highs and cannot find acceptance beyond those highs, if acceptance cannot be established up there and instead there's a failed breakout, that will likely trigger a turnaround where price is now going to gun for the stops below those lows. And that's when this thing gets very significant and a major sell-off occurs. So number one, major rejection day. So once you see a major rejection day, you like what you're seeing, then you look to enter that trade. Perhaps you get in here, perhaps you get in at the absorption zone. So the primary absorption zone develops, you have your absorption days. The absorption days can be 3 to 5 days long. And so, as I mentioned before, 1 to 4 days of absorption is about as much as you get before something's got to give. And if you're absorbing for too long, that's probably an indication that participants aren't getting paid. And at that point, you may start to see market participants jump ship, liquidate their trades, and then that triggers other downside sell stops, and then everyone is forced to liquidate. And then you get a long liquidation down. So the failed breakout is always something I'm looking for. So if you just take this part of the trade over here, this is a rejection day sequence. I'm long, I'm long, I'm long, I'm long. And if I am long in that sequence, I'm always watching those highs for failure. I'm watching up here to see if there's some sort of major rejection. Because if there's a major rejection up here, it's almost guaranteed you're likely going to come down there and test the other edge and see if there's stops down there to knock out. Because what happens oftentimes, for example, what happens is you get market participants that get long, they're long, they're long, they're long. But what may happen as well is that if you're long here, say you buy a position here, you're in 100% of your position, well, when price pops up to here, maybe you take half off. How do you take half off? With sell limit orders, right? You put your sell limit up there, and when price goes up there, it hits it and it pulls back. Maybe someone got long here 100%, and when it gets up here, they take 50% off again, and it pulls it back. So sometimes these long participants, these bulls here, are creating their own resistance. And the only way for price to go higher sometimes is to knock these participants out of their trade by dropping through their stops. And by dropping through their stops, it's one cancels other. OCO. you drop through these stops, so it takes out these targets, these sell limits, and now you've removed resistance, and maybe this thing can turn around some point down the road. So there's various things at work here, but again, if market participants are long and there's a failed breakout, that right there can suggest something like this can be coming. So you always want to be mindful of the failed breakout. It's very, very important. So when bulls attempt expansion here, but a breakout fails, that could be your earliest entry opportunity. Your earliest entry opportunity to get short off of that rejection. So oftentimes, if I maybe didn't get into a position, but it's sitting there for 1, 2, 3, or 4, or even 5 days of absorption, I'm now looking at this side of the chart for signs of rejection so that I can get in ahead of the stop run through the recent lows and likely to fresh lows. So again, that is your earliest entry opportunity. You can establish a full or partial position on that day. Now keep in mind, this is now a stop run day. You reject up here, you run through the recent support, and then here's your midpoint. It's at or below the recent lows. Half the day is above that point, half the day is below it, and usually it's right at the new absorption zone. So this is the primary absorption zone from a bull standpoint right here. When price goes offered through it in a stop run day, that absorption zone becomes a bearish absorption zone. So it changes bias to the downside. And so now when you have a stop run day this way, you can now actually engage a bearish stop run day trade sequence, whereby now you're looking here for a failure that could pull back to the midpoint and a retest. This is your retest after stop run, and now you're in here or adding to positions here ahead of what could be a solid continuation day at 0.7. So again, this turns into a stop run day sequence once the stop run day is in full effect. So you could switch gears to a stop run day sequence as well. So again, very, very powerful sequence here. Whenever market participants fail to get paid, you usually see a significant stop run that occurs. So again, being able to identify that at its earliest points, and usually it's a failed breakout, that's the earliest point to identify it. That could be significant because that could be ahead of what could be a huge day in the opposite direction. So again, stop run day, you got the retest after stop run. That is a great entry opportunity, and then you get the continuation leg down. So let's look at an example. All right, this one is IYT, the Transportation Average ETF. And a failed absorption sequence occurs after bulls fail to keep the absorption zone of a rejection day bid. So here is the rejection day, day one rejection. Significant rejection day develops at a CLVN. Here's your CLVN in the profile. Between 175 and 176. Bulls need to keep the absorption zone bid for a shot at returning price to previous highs. So again, you can see here all these lows right here. Price pulls back, pull back. You get a big move down and a pop. That's a pretty good rejection day. So ideally, you'd probably want to defend the midpoint if you're a bull the next day on a pullback. Because the day closed below the open here, I probably wouldn't jump in at the end of the day. It doesn't look that bullish. But again, any pullback for bulls would be about here. So again, what we're looking for is how are market participants going to respond to a retest of the midpoint or the absorption zone. So the absorption zone develops between the rejection day midpoint and the price that has been rejected. A daily close below the zone will likely trigger a long liquidation. So it's all about the midpoint in this case. Remember, a rejection day midpoint, you got to stay above it or you get a stop run to the lows. So it's all about the midpoint in this case. If we move to the next slide here, you'll see the next day, price opens here rallies a little bit, lower high, and then drops into the midpoint and then closes a little bit above it. So again, down day, where price opens here and drops, but still holds the midpoint. Now the next day after that, another gap down, pulls back and then drops even lower, and this time price actually closes. That's a close below the midpoint. So it didn't close here below the midpoint, but it did there. Now that right there is an indication that we're likely about to see a major continuation lower. So once price closes below the rejection day midpoint, bears will be looking to trap bulls at or above the previous high, which tends to develop as a failed breakout the next day if bears are successful. So what that means is you have a great rejection day here. You have your midpoint retest right here that holds. Now price is here and it closes below the midpoint, but it closed right there. It didn't continue throughout the day. So in this case, because it closed below the mid, everything looks bearish. Watch the prior day's high or this day's high, because if the next day goes above that high and rejects, that could lead to a stop run right through the absorption zone. So again, you have to be able to anticipate a potential failed breakout the next day so that you're ahead of the pattern. And this is what it looks like. So the next day, price opens here, rallies to new highs above this high, and then quickly rejects back down and starts to run through stops, and all of a sudden this thing is gone. Major long liquidation. Again, remember, if you're a bull and you got in on this day, say this was a major rejection, you got in at the end of this day, and then price comes back and defends and you're in again. Say you got in half the trade here and half the trade here, you're now in 100% of the trade, and now price closes barely below the mid, you should be out. You should be out because you're below the mid, and in most cases you're going to take out the low. But say you don't get out. Say you didn't watch Swing Trade Pro 2.0 and you don't know about these rules and you didn't get out here. And now when price pushes to highs, you're feeling pretty good about yourself and you're like, yeah, now I'm getting paid. And then they pull the rug out from under you and this thing starts to drop. Now, again, bulls have been in that trade and they could not get paid. A rejection occurs and now everyone is going to jump ship. And that's when it becomes an aggressive stop run day to the downside and you see a major move lower. So your first entry opportunity becomes the previous high rejection. So after price fails to close above the absorption zone in the previous session, look to execute an entry, full or partial, upon a rejection or retest of the high the next morning. So again, right there off of that point, anywhere in there is a great opportunity to look to initiate a trade. The second entry opportunity will come right here, and that's at the stop run day, right, where price is breaking through 2-day lows, and there's an opportunity here to get ahead of that or to defend the previous low from below upon a retest. So price breaks through the low, returns. Right there is an opportunity to defend for a continuation down. So typically a stop run day will experience an aggressive trend day structure and look to execute a full position upon a retest of the previous low from below with the option of taking profits in the last hour of the day. So again, this is just a classic stop run day, and if you got in ahead of the move or you got in on the break, you want to look to take profits, at least partial, in the last hour of the day, toward the end of the day, maybe in the last 10 minutes of the day, whatever the case may be. And then you can look to add back exposure upon a retest of the breakdown point the next day, if it were to occur. So long liquidation. The bulls that defended the market during the rejection day and during the subsequent 2 absorption days fail to get paid, which triggers the beginning of a long liquidation. So that's how you have to put yourself in the minds of those who are defending. Bulls think this thing is going up here, they're in here, but this thing is going lower and there's rejection. those bulls are no longer going to be bulls because now they got to sell to get out of their positions, and that triggers more downside sell stops, and things progressively get worse from there. So again, a very, very solid move here on a failed new high. So failed absorption is usually triggered by failure, price fails to go higher, and market participants fail to get paid, which then causes a long liquidation and selling pressure. As such, begin watching for failed breakouts and failed new highs when a bullish rejection sequence can't seem to find liftoff. So again, usually if you have a great rejection, great absorption, you're looking for this to pop higher. But sometimes you see a rejection that's not all there, and then you see half or kind of, you know, a lackadaisical type of defense of the absorption zone. It's not really getting liftoff. That's when you should start hunting for signs of failed breakout or failed range expansion or a failed new high, because that's going to be your earliest indication that this could happen. And this is what a continuation looks like. So after building a position during the first few days of rejection, of the rejection day trade sequence, your primary goal is to take profits on the first favorable pop into your zone. So again, you definitely want to see this thing drop in your favor. You want to be able to take profits along the way. For the most part, this one right here, such a sharp rejection at this high right there. And if you notice, this is a stop run day, right? Midpoint here, and it's a huge day. It's also an outside day where the high is above the prior high and the close is below the low. It's also a failed new high because it failed above that high and it dropped. And it's also a rejection day. Maybe not a classic rejection day like that, but clearly new highs were rejected and price dropped. So it's all of those days combined, and that's what makes it such a strong day. Nobody got paid on the upside there. The sell stops triggered and this thing dropped. The next day here, this 6 right there is the retest after stop run. So after this day here, there's a tendency for price to pop back toward the midpoint or come back toward the breakdown point. That offers another opportunity for you to add to your position or get into the fresh position if you hadn't gotten in before. So again, the third opportunity comes on the retest after stop run. Now, keep in mind, the new absorption zone develops after a stop run has occurred. So the absorption zone is adjusted lower to coincide with the midpoint of the stop run day and the 2-day absorption lows. So whereas before, the absorption zone was around the midpoint like this, well, after this thing rejected and broke down, the new absorption zone is this midpoint and these two lows. And so now you have an adjusted and new absorption zone. And now that's the zone where if price pulls back, you can engage for a continuation. Price needs to stay on a closing basis below that level, otherwise a failure occurs. And again, whenever you get a major pop in your direction, or a drop in this case, you want to be able to take profits, at least partial. You want to be able to pay yourself along the way. It's too hard to go all in or all out, 100% in, 100% out, and guess where that ultimate move might go. But being able to take a little here, take a little there, really eases the mind, really helps that mental capital. And for the most part, taking profits along the way on the first pop and then at a target zone usually makes the most sense. So a great move here. And again, you can see how powerful this was. Just think, if this rejection day had worked out, how high could this have popped? I mean, you have lower highs here. Yes, maybe you might have gotten back to these highs, but look at how aggressive the move was when it failed. That's a pretty aggressive move, all because these longs did not get paid. They failed to get paid, and so bang, this thing leads to an incredible stop run to the downside. So again, failed absorption sequence, a very, very powerful pattern. You've got to be able to watch out for these signs when you're in a long trade. You want to be mindful that a failed absorption sequence could occur if there's any failed breakout, a failed new high, that type of thing. I'm always watching for a failure when I'm in trade. And even if I'm not in trade and I'm seeing kind of, a really lazy absorption signature, that's the time to watch for a long liquidation. So again, failed absorption could be the ticket in that case. Now let's talk about the accumulation sequence. This blueprint illustrates the accumulation trade sequence, including identifying tendencies of accumulation and detailing each entry point. Use this sequence when accumulation develops. So accumulation occurs when market participants keep prices in a very tight range, usually near lows, and they build a large position in that area. And they're looking to build a large position, maybe even at times shift value down to that area, and then they're looking to mark prices higher and hand off the position at higher prices. And so again, what we're looking for in this case typically is multiple days, 20 plus days, that would be at least a month, 20 plus days of a narrow range type of compression. At least, sometimes it can be 2 months, 3 months, 6 months. Sometimes you can have accumulation for a year, right? But it doesn't always have to be the case. Once you find accumulation, once you understand it, you'll then be able to identify those opportunities that should be continue to be accumulated, because that is when you usually see a massive markup. Now, the reason why I bring the accumulation sequence into Swing Trade Pro 2.0 is because it's one of the most powerful patterns that you'll come across. This pattern, because it takes so long to develop, has the most energy to release huge moves, not just over the coming days and weeks, but months and sometimes even years. So if you're looking to build a position in something and then hold it for 3 or 6 or 9 months, you want to look for those types of opportunities that have clear signs of accumulation, and then you want to be able to look for the telltale signs that that accumulation will work out. So let's run down the list here of how you can identify a great accumulation range and also how to engage it from an entry standpoint. Number 1, accumulation occurs when institutional investors buy substantial supply of a given stock while simultaneously keeping price within a narrow range for 20 plus days, which eventually fuels expansion and a markup phase. Rounded bottoms are extremely reliable patterns of accumulation. You'll usually hear me say rounded bottom a whole lot of times in my trading room, and what we're talking about, at least in this instance, is when you have a large accumulation range and slowly but surely the right side of that pattern starts to round off, creating higher lows, higher lows, higher lows, until finally you see a massive stop run through resistance, and that triggers a path of markup all the way toward recent pivot highs. It could be a major move that comes. And so when I'm looking for accumulation, I like to watch for signs of rounding. And once you see the rounding off to the right, that's usually about the time where you know that expansion may be coming. Because with accumulation, it can be difficult to understand when or to judge when expansion may occur. Sometimes you think expansion may be imminent, and all of a sudden it goes sideways for another month or two. And that's, you don't want to be holding inside of accumulation range for too long. You want to be able, you can, but you want to be able to have your money working for you right away. So if you can get in on the right side based off of failed new lows or absorption or the stop run day or the retest after stop run, any of those can get you going in the direction right away. So again, there's going to be signs here that we look for, and we'll cover those in a moment. Number 2, the breakout and absorption zone. So the zone between the stop run day midpoint and recent resistance, that's the zone that is the breakout and absorption zone. This is the zone that bulls will use to defend their trades or establish new positions. And a daily close below this zone will ruin this trade and trigger a stop run to the downside. Thus, positions must be exited at this time. So that's this point right here. That's point 2. So as accumulation is developing, like this, like this, like this, like this, usually there's a clear area of resistance. Very, very clear, uniform area of resistance. That is your absorption zone. And it's also the breakout zone. So when price breaks through that area, that's the area where you're going to see a stop run day, and that's the area where you're going to see the retest after the stop run. Price needs to stay above that level if it's going to survive, for the most part. There are times where it can close back below it and still remain bullish, but for the most part, you would want to price to stay above that breakout / absorption zone. If not, the whole trade can crater. So again, you want price to hold above that zone. Now, number 3, the rejection day. It can be challenging to discern when expansion will occur from the accumulation phase, but rejection days on the right side of a rounded bottom can oftentimes precede expansion. Establish a partial position on this day or the next session at the rejection day midpoint. So oftentimes, once you get toward the tail end of an accumulation range, sometimes price will do a shakeout leg where the market drops significantly, it shakes out people from their positions, and then by the end of the day, it's back toward highs, and it's left behind a major rejection day and or failed new low. It's these failed new lows within an absorption type of pattern or accumulation sequence that usually tells you that you're about to see expansion. So I'm always looking for failed new lows on the right side of the rounded portion of this accumulation pattern. If you see a major failed new low like this, it could be an indication that you are about to see expansion and markup. This is absorption. So again, rejection day here, failed new low, that type of pattern. You can get in at the close of that day in the last hour of the day. You can also wait for the absorption day, the next session, to come back to the midpoint of the rejection day, and that provides an entry point. There's also the stop run day. At some point, you're going to see a stop run day through the accumulation pattern highs, and then that's going to lead to a major move. Now, sometimes price will just rally through it like we did here. Sometimes perhaps there's earnings, and then after a good earnings report or maybe good forward guidance, price will gap above that area and then start to run. Those are my favorite, because that's when you know that thing is going. There's no guessing anymore. You've got a major gap out of range in value. You got a major continuation. Those are huge. And now any pullback to the midpoint then, or maybe a failed new low, or as low as an absorption point retest can be a great entry. So they're all going to look a little different sometimes, but again, you want to see strong breakout through the breakout point and the absorption zone, and then you want to see bulls defend pullbacks. That's how you know you got a great breakout. Now, in terms of the retest after stop run, again, depending on how the breakout occurs, this portion can be right back at that low, or the breakout point right here, or it could be the midpoint of the stop run day, even if the thing gapped up, right? So the retest after stop run, again, can be the midpoint or the absorption zone. And then again, you have your continuation leg, and that's a great spot to take some minor partial profits. But again, with this type of pattern, you want to hold for the longer term as well, because down the road, 3, 6, 9 months later, this thing could continue to be marking up for much, much higher highs. Let's take a look at an example. All right, here is an example of PSX, which is Phillips 66. Price had built out a very clear rounded bottom here. You can see how price had dropped significantly from 108s all the way down to about 89 or so. But then after it dropped, getting to the lowest point about right here, it could no longer get lower than that point anymore. That was the lowest point it got, and then it started to come back and form higher lows, and then all of a sudden we had a rounded bottom developing. Additionally, toward the latter part of the range over here, things got even more tightly coiled. So it went from being tightly coiled here to even compressing even more. And then the sequence really starts about right here. because this is when you have a major stop run to the downside, but by the end of the day, it's back above the previous session's midpoint. That's a huge failed new low, a huge rejection day. You can see here, if you take it all the way back, it took out lows going back over the course of 4 to 6 weeks. And that rejection was the beginning of what could be an early breakout opportunity. So accumulation occurred for 8 weeks here. 8 weeks, which builds plenty of energy to fuel a big move. The range further compresses in the last 3 weeks, which suggests expansion may be forthcoming. The rounded bottom is also an indication that expansion may be near. And then the rejection day is also an indication that expansion may be imminent. So again, these are all indications here that we could be looking at a breakout. And then you see your first entry opportunity right here. If the rejection day is confirmed by the end of the day, look to execute an entry during the last hour of the day, either partial or full, again here. Second entry opportunity. The breakout, the next session, offers an opportunity to add to this position or initiate a new position. So in this case, you see a major gap up above the high, and then here's your retest. And again, that is your secondary absorption zone, right? So you have your entry point at the last hour of the day, you have your entry point at the midpoint of the rejection day, and then you also have your range retest. So if price were to gap up, any pullback to the prior high or close offers your entry point. And in this case, that was the right point in that chart. Now here's your third entry opportunity right here. That's at 0.6. That's your failed new low and also stop run, retest after stop run. So you see another failed low here. Price opens here, drops down, takes out the low, and by the end of the day, again, back up toward these highs. Again, that right there is a failed new low. Failed new lows can be played by themselves, or they can be played within the within a trade sequence. This right here, failed new low, provides another entry opportunity. And again, there's an opportunity to either defend off the low or an opportunity to get in at the end of the day to confirm that that was indeed a rejection. So again, many different factors here to look at with regards to an accumulation sequence. Again, the accumulation sequence is one of the most powerful patterns that you'll come across, and this pattern develops over many weeks, months, and sometimes even years before releasing significant energy once expansion occurs. Rounding and rejection on the right side of the accumulation phase can be tells that price is nearing expansion. Let's fast forward to the next chart here. You can see that after this phase of accumulation, remember about 8 good weeks of accumulation, you get the breakout right here, and look at the aggressive push higher. A big time breakout and a continuation. The first pullback to the Pima trigger zone is defended, failed new low, defended, failed new low, defended, failed new low, defended, and then sideways eventually. But a major move higher. Now again, all of this energy right here that came out can be directly related to all the energy that was accumulated in this zone. This is the fuel that leads to this move. This is, I usually say in the trading room, this is like gassing up the car at the gas station before a long distance trip, right? You have to gas the tank up, you got to fill it all the way up, and then that's going to be the reward. There is the amount you're able to drive, because again, this move doesn't happen without all of this energy being built up first. And that's why I love a pattern of accumulation, because it can trigger a strong markup phase, and that markup phase can take, if this is 8 weeks of development, this markup phase can be about 8 weeks of markup, give or take. And that has been a foundational concept that has stuck with me for 20 plus years in this business, and you see it over and over again. 8 weeks here, about 8 weeks here. It's not exact. You know, sometimes this can be 6 weeks of rally, maybe sometimes it can be 3 months, but again, it's going to be about the size of what the accumulation was. So again, pretty strong here. Now in terms of the transition phase, right? You're transitioning from an accumulation phase and you're transitioning to a markup phase. And so ideally, the transition from accumulation phase to markup phase should be quick and aggressive. If it's going to transition from one phase to another, it's typically going to be a strong push first. If price had sat here, sat here, sat here, above the highs here, above the absorption zone, it never really went, and it was taking its time, I mean, that gets a lot of people long, not a lot of people getting paid, and that's when you see a long liquidation that could come about. So again, it's very important that when you do see a breakout, the transition phase from accumulation to markup ideally is an aggressive one, and you should know right away, you know what, this looks strong and it should continue higher. Again, the time-based target, the phase of accumulation lasted about 8 weeks, which means you can forecast about 6 to 8 weeks of expansion during the markup. That's something that you always want to know. Managing the trade after building a position during the accumulation sequence, look to hold the position for a longer term move, anywhere from 6 to 8 weeks to a year, depending on the phase of accumulation. This is a time-based trade that requires patience. Look to hold as long as price maintains its market structure. This is very important. Look to hold as long as price maintains its market structure. That means if this thing pushes up and you're in, that's good. And then you pull back right here, provide support, and that's good. But as soon as that market structure is violated, perhaps that might be the time to give up on that trade. But for the most part, as long as that market structure remains intact, this trade should be held to completion in most cases. Very, very powerful trade. Again, the way that I usually would engage this one is first with a swing to get a swing move in there, and then hold a portion for the long-term continuation. There's also times where, say for example, you're in 100% of your trade here. You can look to take a third, right? You know, every end of each month or something like that as it continues, or hit the first target the first month and continue to work toward. You can add back at pullbacks along the way as well in these areas. So all of those are add back opportunities, because once price gets into a very clear markup phase, every pullback can be an opportunity to either add to your position or trade it outright as a standalone trade. And so again, it becomes a very, very powerful way to trade, because you have clear confirmation that a markup phase is in full effect, and you can lean on that phase because it's likely going to continue to progress in that direction because the accumulation phase was so significant. So a solid pattern. Again, we've seen many, many stocks that have accumulated over the last year or two that have doubled easily in mere months, sometimes just 5 months. Sometimes it takes about 9 months to hit its target. Sometimes it's much, much quicker. But again, it all depends on the size of the accumulation. Everyone's a little different, but I love when you see rounded bottoms, because those rounded bottoms tend to lead to explosive moves in the market. All right. Well, that concludes Swing Trade Pro 2.0, Step 2, Trade Sequences. Trade sequences are extremely powerful. The date type blueprints that I taught here, and also the trade sequence blueprints, are very, very powerful. In and of themselves, you can trade them as day trades, you can trade them as swing trades, and even with the accumulation sequence, these can be investments as well. And again, being able to understand all of the various entry points that these sequences have, being able to understand all of the various failure points, the absorption zones, where to do what, very, very important. Once you have that in your toolbox here, you can then understand when to engage these markets, when to anticipate certain moves, and then you can plan your approach accordingly and be ahead of the market. So again, trade sequences, one of my favorite parts of this Swing Trade Pro 2.0 course, and I hope that they prove to be very, very useful in your trading as well.